Good morning, Trinidad and Tobago. Season's greetings and welcome to the Bourse Report. Today, we take a look at the final year-end results of two banking stocks on the local exchange, First Caribbean International Bank and Scotiabank Trinidad and Tobago. Both of these stocks would have had commendable performance from a corporate perspective. However, their stock prices would have fared quite differently year to date, with First Caribbean International advancing some 70%, while Scotiabank has been down just around 5% year to date. Let's take a closer look at the corporate performance of each of these, as well as what could impact these stocks going ahead. And here we can see for Scotiabank, for the year ended October 2016, they posted an earnings per share figure of $3.55, a 10.4% increase from their 2015 figure of $3.21 in the year prior. This was driven primarily by an increase in net interest income of 15.8%, and overall total revenue increasing around 9.3%. Loan expenses almost doubled from $38.6 million in 2015 to $76.8 million in 2016, or a 99% increase, and operating expenses also increased around 5.4%. Now, notably, while net interest income increased around almost 16%, net loans to customers grew just around 1.4% as reported by the company, which suggests that most of this increase in net interest income would have come about as a result of widening net interest income margins. The company paid a second consecutive special dividend, this time $1 per share, as opposed to the $1.10 in 2015, bringing total trailing dividends to $3 per share, or a total trailing dividend yield of around 5.1%. Excluding the special dividend, regular dividend trailing yield was around 3.4%, below the sector average of around 3.9%. So how does Scotia stack up to the rest of the competition? Well, as we can see, at the current price of $58.69, they're trading at a trailing multiple of about 16.6 times, and that's above the sector average of about 14.4 times. As mentioned, in terms of their trailing dividend yield, regular dividend yield, they're at around 3.4% compared to the sector average of 3.9%, and their market to book value is above the sector average as well, and Scotia is trading at around 2.7 times market to book compared to 1.7 times sector average. What could affect the company going ahead? Well, the recession in Trinidad and Tobago is one of the obvious factors. As consumers become more cautious about their spending patterns and what they spend on, credit growth could become constrained. We also see that corporate taxation will be another factor that they have to contend with, whereby for profits over $1 million Trinidad and Tobago dollars, they will be paying a 30% tax rate as opposed to 25% come January 2017. So on the basis of a reasonable dividend yield, but tempered by the effects of recession and corporate taxation measures, Bourse maintains its neutral rating on Scotia. Turning to FCI, for the year ended October 2016, FCI reported earnings per share of 61 cents TT dollar equivalent, an increase of almost 49% in TT dollar equivalent from the year ended 2015, which was 41 cents earnings per share. This was driven really by a 2% increase in net interest income and a 2.2% increase in total revenues, as well as a sharp decline in loan loss impairments from around 282 million TT equivalent to just around 117 million TT equivalent, or a 58% decrease. Income after tax rose 46% from $665 million to just around $975 million. So, FCI looking ahead, the recession in Trinidad and Tobago may not be that significant to the performance of the company, and that's because just around 2% of revenues come from the Trinidad and Tobago market for FCI, and this is as per the 2015 annual report. However, looking at the two main operating jurisdictions, Barbados and Bahamas, those areas are expected to grow just 1 and 1.17% respectively for the year 2017, according to the IMF. And as we can see, Barbados accounts around 31% of total revenues, whereas Bahamas is around 26%. In terms of stacking up against the competition, well, First Caribbean trades at a trailing multiple of around 14 times, which is just below the sector average of 14.4 times, and offers a trailing dividend yield of 3.6%. and that's, again, below the sector average of around 3.9%. Important to note, however, First Caribbean does pay its dividends in US dollars, which is quite handy for the Trinidad and Tobago investor, where you are able to invest in Trinidad and Tobago dollars and get US dollar cash flows in return in the form of dividend payments. Again, the FCI is just below the market average in terms of market to book at around 1.5 times. And on the basis of an attractive dividend yield, a moderate valuation, and US dollar cash flows in the form of dividends, Bourse maintains its buy rating on First Caribbean International. That's it for this week's edition. For more information, give us a call at 628-9100, email us at invest@boursefinancial.com, and to find out more about how Bourse can add to your value, visit our website at bourseinvestment.com. Have yourselves a great investing week. This has been the Bourse Report.